I'd like to welcome everyone to our second lesson in the Market Profile Beyond the Basics course. In this lesson, we are going to be looking at some of the basic techniques for trading with the profile. But as usual, before we begin, we need to quickly review the disclaimer together. Trading and investing involve high levels of risk. Future results can be dramatically different from the opinions expressed in this course. Past performance does not guarantee future performance. The presenter may or may not hold positions in the financial instruments discussed. The title of this lesson is really Trading with the Profile. And it is the first lesson where we will actually begin to look at various trade setups, if you will, or trade opportunities, identifying them and looking at how to capture them when they do occur. We're going to be looking at some of the very basic ones in this lesson. But before we begin, I want to highlight some general facts about the profile as a trading tool. The profile TPO chart in itself is not an effective trading tool, or I should say that very few traders trade right off the TPO chart. The TPO chart is more of an analytical tool for us, and it is in fact a very powerful analytical tool at that. So using the profile is very helpful for us in our trading, but the important thing is to know how to use it and how to employ the profile on our actual trading charts. The third point that I want to make about trading with the profile is that it is very important to combine technical analysis with profile data. Just because you are using a profile does not mean you have to abandon the cornucopia of analytical tools that are out there. By the same token, you're not going to inundate your chart with them, but nevertheless, they can often be very helpful, as I will demonstrate for you in this lesson, and even some of the most basic technical analysis tools will be useful once we integrate them with the profile. Next is another very important point for anyone who's trading, and that is the time frame. The time frame is crucial, and selection of the appropriate time frame for your profile is paramount. So if you are going to be doing some day trading, and I will look at some intraday strategies today, the settings are, of course, very different from someone who is going to be doing some swing trading. Your time frame for the profile is crucial. It is also important to understand that different instruments have different characteristics and different sessions. And so it's important to adjust the profile and choose the appropriate settings depending on the nature of the instrument that we are going to be looking at or the instrument that will be traded. All right, we're going to begin with an intraday strategy, as I mentioned. So we're going to look at how we use the profile in intraday trading. And we are going to begin with a trading chart that will be 30 minutes and very simple, a basic candlestick chart for our trading chart. So we're going to trade off a 30-minute candlestick chart. Now, the key question that is often asked is, why in the world 30 minutes? Why not 5 minutes? Why not 10 minutes? Well, 30 minutes helps us to reduce some of the noise in the market. It is enough time for me to get a good feel for what is going on in the market. 5 minutes, 10 minutes, and 15 minutes usually just are not adequate for that. And at the same time, if we go shorter, as scalpers used to do at one time, in terms of just 1 minute charts or half a minute charts, that is very, very noisy. That just is incredibly difficult to trade. In addition, the 30-minute time period gives us meaningful transition points. meaning if something is going to happen in the market in terms of a major change, usually it's going to occur on the half hour or on the hour. So the 30 minutes lends itself to that. And then in addition to that, it also is in alignment with the default profile settings. When you look at any standard profile, you will find that it uses a 30-minute period. So there before you, we have a basic 30-minute candlestick chart for the ES Mini. Now, it looks very bare as it is now, and of course, we could make the argument somebody could trade it simply just on candlesticks alone, but our objective is to make the process as easy and as coherent as possible. And so one of the things that we need to do is to add the profile tool to the chart. And immediately when you do that, you begin to see a whole different picture of the market. It really changes the landscape completely for that 30-minute chart. And as you can see, this is a truly distinctive image and a very different image from the TPO chart. This is more of the applied approach to the profile, how to actually begin using the profile and the profile concepts on the actual trading chart that we will employ. And in doing so, you will begin to see, for instance, that I can see exactly what happened during a particular session, how the other session, where it picked up, and how things continued. So we have 3 different sessions going on this one chart. Now, to be able to use this tool, it's really quite simple. And to break up the profiles into sessions, at least for the ES Mini, as I have done on the previous chart, I have included this slide with the different settings so you can take a look at them and create them in your own platform. And here I am using Market Delta for the platform for these slides. So I won't go through the process of how we set it up. I'm going to rely on you to do that. I'm going to focus our attention in our lesson on our strategies and how we actually begin to trade using this powerful tool. First of all, let me point out that there are many different options to display the profiles using the tool. We can have a single color profile, as we do in this slide. And in this case, the single color changes intensity based on the intensity of volume at the price level. So the darker the color, that is the more intense, the greater the volume levels at these prices. And you can also see how on the histogram they tend to extend out further than some of the other nodes for the other prices. As volume is reduced or diminishes, then we begin to see lighter colors, but they're all basically shades of the same color. The other thing that I want to highlight before we navigate too much further is that this is a volume-based profile. And in my trading practice, I only use volume-based profiles. Some like to use both, some use one or the other. These are some of the preferences. In my experience, I have found the volume to be far more effective and far more reliable. All right, now this is another way to visually display the same data, but in this case we have the different rainbow colors, and the purpose of having different colors instead of having the same exact color is that now hopefully you are able to see the different volume levels a little bit easier. Red being the most intense, and then we drop down to orange, and then yellow, and then light green, and then light blue, and then dark blue, and then black for the lowest levels on the chart. So the color coding is really intended to help visually identify, again, those high volume areas and the low volume areas. And it's a matter of preference and choice. and I leave that up to you whether you want the full colors or whether you want the single color. All right, now we have 3 different sessions as we discussed earlier, and on this slide we label them as A, B, C. A profile is usually most meaningful at the conclusion of the session and helps us to begin trading the session that follows. That is not to say that I can't actually trade the profile while it is under development or in development. I can do that as well. However, the most valuable information is usually taken out of the profile or distilled from the profile once the profile is complete. So we are going to employ one of the most basic concepts here for our trading strategy, and that is the value area. We're going to look at where the value area is, and we're going to trade based on where price is relative to the value area. Now, keep in mind that when price deviates away from value, be it to the upside or the downside, these are the most lucrative opportunities, if you will, or the times when the market may be embarking on a strong directional move, when we are either leaving value to the upside or leaving value to the lower side. In this case, in session A, the value is nicely and clearly highlighted for us. So let's study what we can discern just simply by looking at the chart and looking at what is going on with the candlesticks at the different value area parameters. Here we see a cluster that has formed, a cluster of activity. We have about 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 30-minute periods that sort of have had some activity in this general area. And you can also see that on the volume profile, this activity has in fact created a cluster on the profile. So you visually unfold the cluster into 30-minute periods on the chart using candlesticks, and you are also able to see the volume accumulation here. And it's all around this area of low value, the value area low for this particular session. Now, take a look at what is happening. We can see that this has become a level of support. First of all, we're coming up into that level, and then we've rested there. We've spent some time. The market has done a rotation, and if you take a look, there are a number of wicks to the upside indicating upward pressure and buying pressure, and then ultimately this last candle here, this big candle, as soon as it takes out the high of that range, that is an indication of a breakout of that cluster. Now notice how breakouts usually become visible on the profile. They are what we call valleys, or areas of low development. They are areas where the market really just does not spend a lot of time, because the market breaks out of there and starts to move higher. And sure enough, that's what we have here. And then we began to develop another cluster up here at this level, which happens to be the volume point of control. Now, one thing I will tell you that is always useful on your charts, that makes it easy to read and follow your chart, is to make sure that the color codes that you use are consistent on different charts. And you will see in my lessons, I will always use the color green for a value area high and a value area low to identify the value area. And I will also use the color red for the volume points of control. So even though I don't have them labeled, visually I know right away what they are because of the color codes. So now we begin to develop another cluster. And let's take a look at what happens at this other second cluster? Well, once again, we find that we have a level of support at this volume point of control. You see the same wicks pushing up. We've tried to break to the downside, but price comes right back up again. Up here, we met some resistance at the value area high, but we came right back to it. In many ways, the pattern here is really very similar to the earlier pattern that we saw here. Once again, we see another breakout and price continues to move higher. What is interesting now is we are beginning a new session, what we defined earlier as session B, this session here, and price is now outside of the value area. And we know that once price moves away from value or outside the value area, one of two things is going to happen. One, price may in fact continue moving on higher and higher, or price will return back to value if in fact the levels outside the value are not accepted. So this is why we know there is a potential trade opportunity anytime price begins to deviate or move away from a defined, as we have here, and a formed value area. So in the new session here, and this would be an evening session, if I wanted to trade in that evening, I know that price is outside of value, and I have to make the decision, is price going to go back into value, or is price going to continue higher? And I will show you how, in fact, it really is not that difficult to make that determination, and how one can capture some of these trades without great difficulty. So the first element, or the first piece of the puzzle, is that price is outside of the value of the prior session or this session here, and that is actually very easy to see. We are outside of value right here in this area. All right, so now that we have that, what do we do now? Well, what is important to do, and I've now magnified the image so you can clearly see what's going on. This is the same exact chart, just a closer look at what's going on. This is the first candle that has closed outside of value. So this is when I need to think about making a decision. Just because price closed outside value, that does not give me adequate information as to whether I need to be long or short in the market. It just simply identifies the existence and the occurrence of an opportunity for me in the market. Now take a look at the following 30-minute period. The first thing that I see is a wick or tail, a long wick or tail on the candle, and notice that the tail begins right down here, and notice this volume node of a little bit higher volume, and prices shoot up, and we end up closing above the open. So what does this candle tell me? It tells me that prices dropped back to the value area high, thinking that we may be coming back into value, and what happened was a buyer or a group of buyers, buying demand, was apparent in the market at this level and would not allow it to come back into value and pushed prices higher. So once I begin to see this candle form, and the fact that we also took out the high of the prior candle, that might be the triggers, the beginning of the triggers for me for my long entry. At least price is not dashing back towards value. If anything, it is indicating the market wants to move higher. In addition to that, this candle has created a higher low than the preceding candle, and we also have a higher high between those two candles. Another bullish indication or sign in the market. Higher highs, higher lows. So An aggressive entry for this trade would simply be to enter the trade immediately once this candle breaks the high of this candle. So I would be in the trade. Now, mind you, we could in fact see quite a bit of movement up and down within the candle, and it depends on how the candle develops. Possibly the market may have opened and then went higher and then came back lower. If in fact the market had done that, the reason that this would be an aggressive entry is because if we did that, the stop loss is still way down here, and so I have quite a bit of exposure. However, if I wait until this candle has closed, my stop would be right at the value area high, which was already tested, and I would be comfortable with the trade. So a lot of that is the timing of when you enter the trade. So if you enter aggressively, you may have to keep a fairly wide stop loss. If in fact you enter a little bit more conservatively, once this candle has formed, then what happens is you have a much tighter stop loss, if you will. So the key is once the high of this candle is taken out, that's an indication we are probably going to move higher. And the price opportunity should really, of when to enter the trade, should be to wait until this additional or this next 30-minute candle closes rather than to enter immediately once we take out the high. And the market often does that. You have to be very careful with that. It indicates it is going to move higher, and it knows it's going to move higher, but then it starts to shake everybody out by dropping back lower and sort of indicating the opposite of what it's going to do. And so that's why an entry up here would have been somewhat of an aggressive entry. So the more conservative entry for this particular trade would be after the candle settles and closes, and we would enter again at this level somewhere here. Now, of course, once this closes, this candle opens, so at any price, the best price that you can get, once this new candle opens, you are in the trade long, and you know that your stop is down here. That's a far more conservative entry. And always keep in mind that entering a trade, you have a little bit of flexibility. The market usually fluctuates, and so you can buy it right at the open, or you can wait for it to dip a tick or two and then pick it up. A lot of people rush in as if they have to capture the price opportunity, not realizing that the market spends quite a bit of time fluctuating around any price, and there's always a reasonable range price for which you can pick something up. All right, now we are going to look at how much easier this is when we begin to add some technical tools to the chart. And I'm not talking about any sophisticated or complex technical tools. This is nothing more than simply adding two simple moving averages. Now, you can hopefully see how powerful that 30-minute candle image was transformed when we put the profile on it. And now I will show you what we call spoon-fed trades, or they become very easy trade opportunities once we add the moving averages to the chart. Here, in this case, if we had wanted to trade within this session, notice what is happening. First of all, this is the simple 5 moving average, the green, and my 20 is the simple 20 moving average, the blue. The 5 is above the blue, and remember, these are for intraday types of trades. So once I begin to see that the simple 5 is moving towards the 20 and yet spoons up and starts to reverse and head higher, I know that this is an opportunity for a long trade. And notice how often it happens, and also notice when it happens at key levels on my profile. Notice that it's happening right here at the value area low. So as the spoon begins to rise, I could enter my trade right here. It gives me the comfort, the confidence that this is a positive long and a high probability trade at that. Again, at another period of congestion, same exact pattern reoccurs. I have the spoon forming, and as soon as the spoon begins to move upwards and price along with it takes out the high of this candle, I'm in the trade again as a long. And actually, you could use the reverse of the spoon up, meaning once the 5 starts to point towards the simple 20 moving average, this would be the cue for my exit. So I would rely on the simple 5 to help me stay in the trade. Other people, rather than using the bends on the simple 5, they will look at the close of the 30-minute candle relative to the simple 5. So these spoon trades are very, very helpful when we have a trending condition. When there is a trend, an intraday trend in the market, one, they help us to spot the trend quickly, and two, in addition to spotting the trend quickly, they're really easy to capture and fairly easy to trade. How do we spot and how do we identify these wonderful spoon-fed trades, if you will? The first condition is you need to have the 5 simple moving average above the 20 simple moving average. Second, the 20 simple moving average needs to be sloping upwards. You don't want it to be flat. Of course, you don't want it to the opposite if it's sloping downwards. So see here, when we begin to look at a period of congestion, notice at how the simple 20, the slope of it is more horizontal, and we really don't have a nice upward slope as we do here. So you need to have, for the second condition, the 20 simple moving average sloping higher and sloping up. Now, notice also that when the 20 simple moving average is above the value area low, this is a very high probability trade. Once we get the simple 20 average above the value area low, that even increases the probability yet. You want to buy the 5 simple moving average spoons. This is our trade cue, and here's the first one based on this setup, this high probability setup, and here's our second one. This one really is not would not qualify as a very good spoon, even though it did have 2 30-minute periods to the upside. But you could begin to see that, in fact, several things were happening here. One, the 5 simple average has begun to move closer and closer to the 20, and the return pattern from the 5 has changed. For the first time now, we have 2 subsequent moves towards the 20 simple moving average. A strong indication that the trend really is not in play anymore, and we are probably going to stall for a period of time or consolidate. And then potentially we could have another trend continue from here. But never assume the trends will go on forever, and you always want to look for the clues and hints as to when they will conclude. Now, if we wanted to even make this more obvious, remember the comment I made earlier in the lesson about integrating and using technical tools. Notice how just the simple moving averages helped us immensely with the profile. Now I've added a stochastic, and take a look now at some of the trades that we were looking at a little bit earlier, and let's look at how the stochastic helps us. Here in this case, right at the level of support at the volume point of control, when price in fact takes out the high of this preceding candle, and I see that I have the stochastic moving upwards with me, that gives me a high level of confidence that the trade is probably going to bear fruit for me on the long side. And so I could have entered right here. Now, once again, if you take a look and we enter the trade up here, the stochastic is still moving higher. There are no dips, and it's also well above the 80 mark. Now, keep in mind that whenever the stochastic is above the 80 level, that is a bullish stochastic, and there are times when the stochastic could remain above this level for prolonged periods of time. So when we use the analytical tools, they also help us to gain an additional piece of evidence, if you will, for the confluence that we're looking for on a trade. All right. So far, we've been focusing our attention on how to use the profile as a trading tool, and we've looked at some very simple, some very basic intraday setups and opportunities that we identify based on the value area. Now, keep in mind that the profile is not a one-size-fits-all. So different profile settings are going to be required for different types of instruments. And instrument behavior is what determines our profile settings. So the settings have to be made according to how a particular instrument behaves in the marketplace. We're going to switch gears now, and we're going to take a look at a very different market. We've been looking at the ES Mini, a futures market, a 24-hour market, but now we're going to look at a different market altogether. It is also a 24-hour market with a number of different currency pairs, and that is the Forex market. In the prior market, the futures market, I identified for you that we were using a 10-20 minute profile so that I would break up the session into the evening and the day sessions, and I had different sessions shown on my 30-minute chart. In this case, now when I'm going to the Forex market, the 10-20 will not be the most efficient or the best way to identify opportunities as a result of the behavior and the nature of the Forex market. I will instead be using a 240-minute profile and 30-minute periods. And we're going to be looking at what we call the 240 break strategy. Now, the 240 is the 240-minute profile is more in alignment with an intraday move in the Forex market, which is a 24-hour market. Now, we have 3 different sessions within that 24-hour period. We have, of course, the Asian session, we have the European session, and we have the US session. By breaking up the 24-hour period into 4 segments, it gives me a much greater opportunity to capture moves from these various different markets throughout the 24-hour period. We're going to use the same profile concept, or we're going to employ the same concept that we used earlier in this strategy, meaning once price leaves value, there is a potential for a directional move. Now, the direction could in fact be away from value, or the direction could be back towards value. When the price is going to move away from value, we are going to have a breakout. So if we are above value and prices continue on higher away from value, we have a breakout to the upside. If, on the other hand, prices have dropped below value and we have a breakdown, then prices are going to continue moving away from value to the downside. Or we would say that there is negative pressure in the market, or there is heavy supply, lots of sellers, and that would be the scenario that would push prices away from value and cause them to continue to move lower. I'm going to use, again, my profile tool, and this time, though, the settings for the tool are different. It's a 240-minute profile. Even though I am on a 30-minute chart, I'm looking at a chart of the euro US dollar. I have now put, just as we did earlier, several profiles on it. These are not different sessions in this case. These are just different 240-minute periods for the euro US dollar. Now, let's take a look at how we want to trade them and how we're going to use the 240 2-hour advantage. And that 240-minute profile is just remarkable on the euro US dollar. It helps you to really identify many good opportunities once they occur in the Forex market. So let's take a look here. We have a cluster of activity that has taken place during this 240-minute period. And of course, once again, hopefully by being able to identify my color codes, the value area high and the value area low, band or limit for me my actual value area. So here's the value area for this particular cluster. Now, what has happened, or what has been happening, is prices have dropped into this area. They tried to move higher, found resistance, and then they tried to move lower and found support. So we have a support level here, and we have a level of resistance up here. The market is now pushing higher for another retest of this level of resistance. So possibly, very possibly, the resistance will be there, and the market will come back right back to value. But in this case, let's take a look at what actually happens. The outcome of this activity is this price, or this candle, closes above value, bringing us to that magic point where we are away from value. So in this case, we have a judgment call to make. Do we want to be aggressive, or do we want to be conservative? And the way that we make this judgment call is basically we look at risk management. If in fact I'm going to be aggressive and I'm going to go long the minute that this 30-minute period exceeds the high of this previous candle, where is my stop going to be? Now, if I'm going aggressive, my stop would have to be fairly close, and it would have to be right here at this volume point of control. Notice the red line, again, consistency with the colors. So at the volume point of control, the VPOC. This would be where I would put my stop. Now, if I wanted to be conservative, the problem with being conservative with the Forex market is that the moves in the Forex market are usually rapid and quick. That's the nature of the market. The market just doesn't look back. It's a very different market from the futures market. And so if I wait for this candle to close, look at how much of the move I will have missed. And yet, here, my risk exposure really is not that far from where I'm entering. So as a value judgment, it may make good sense to actually go ahead and enter the trade and recognize that your stop loss is going to be down here fairly close to you. So this would be a good aggressive entry. And sure enough, price continues to move higher. Now, another conservative entry, or a little bit more cautious, I should say, would be to have waited for price to clear the high, and I would enter up here. But notice how much more we miss out of the move. The nice thing sometimes about some aggressive entries is that they yield a lot and their risk exposure is low because I'm close to the point of where I would exit. Now, notice other things that help me to determine that this looks like it will be a nice trade to the upside. We get a close that is within value on this preceding candle, and the next one right away is a close above value. Okay, now if we look also at what's been happening, in addition to the close that we had here above value and the next close the close in value and the next close above it right above value, we had the value low tested twice here and it held. So there is a good level of confidence that the pattern that I see is a nice positive pattern to the upside. That would give me more confidence in taking a more aggressive stance and taking the aggressive entry in the market. You have to look at the full dynamics of what's going on. Now, someone else may actually have been even far more aggressive and decided to enter right here at this point before we even deviate away from value, thinking that at minimum we're going to go back up here for a retest of the value area high. That's also a reasonable entry. And if it continues higher, they could add to the position, or they could re-enter, take some profits here and so on. And in this case, the stop would have been very obvious right here at the low and enter right at this point. So there are a couple of different ways to trade the market, and a lot of it has to do with some judgment calls. But what is really beautiful about this is how the profile gives me the visuals I need to determine where my risk management ought to be. So I'm not picking some arbitrary number. I am actually using data from the market to tell me this makes sense for my risk management. In this case, this was the lowest point within the 240-minute period. This was the point when I had 2 wicks consecutive, a double bottom here, if you will, or a tweezer. Notice, so there were certainly buyers here. This is a very logical point for that. Another person may have chosen the value area low. If I come back and for a retest of the value area low, I don't need to be this low as my stop loss. There needs to be a thought behind how I choose my risk management. It's not arbitrary. And the more you understand the parameters of the profile and the more you learn how to use them, the better trades you are going to be able to capture and take. So here, if we enter above value, the logical stop is, of course, right at the volume point of control, because we could come right back to the volume point of control. If that fails and that does not hold, we definitely are probably going to come back for a retest of the volume area low, and there's no need for me to take all that torture. It just means that we're not going to break to the upside. I should exit that trade. All right. Now, just as we did earlier with our ES Mini, I'm going to make things very, very, very simple by just simply adding some moving averages. We're going to add 2 moving averages, and you can already see them here on the chart. I have a simple 5 and I have a simple 8 moving average. The 5 is the green and the 8 is the orange. Now notice once again, these two, or the combination of these two, work much better with the 240 profile on Forex. So different tools, different settings for different instruments. And what happens often is someone tries to use the same settings, same tools on different instruments and does not get positive results, and they think the system does not work. The problem is, again, in trading, there is no one size fits all. There is no one rule that will work on every market. There are concepts, and you have to apply them, and then when you apply them, you have to adapt them to the nature of the market that you are trading. So here I have several things that now, once they become visible to me, encourage me to take the trade. That spoon effect that we talked about earlier. Not only that, my simple 5 is heading above the volume point of control and is also with me as I exit value. And notice the nature of the slope of the simple 5 moving average followed by the slope of the 8, both sloping up. That is a very nice long pattern, gives me high level of confidence in these entries. And the simple moving averages are just real simple tools, but they take on a whole new meaning once you begin to use them with the profile tool on the chart. So again, look at how, now if I were to ask you, once price was outside of the value area of the 240 and you see this pattern folding, and I ask you, before you see any of this, now would you be taking a long or would you be taking a short here? Does it look like the moving averages are heading lower and we're going to move back into value, or does it look like we're going to get a breakout of this level and move higher? And notice how the moving averages really help me to answer that question very easily. All right, so using my moving averages then, if in fact I would have entered here at this point, right here, when prices were above the value area high, and used my general rule that an opportunity occurs when price deviates away from value, I would have had an entry of 1.35 at 1.3512, and I could have stayed in this trade all the way up here to this point. And now, why would I exit here? Well, the answer is really very simple. In this instance, what has happened is we have created a higher high in the market, and then we see a wick, a very strong wick. Not only that, I also begin to see where my price is relative to the simple 5. Now notice, I'm starting to deviate away from the simple 5. The more this distance increases, the less likely the trade will continue higher. So notice here we had a slight increase, but we came back down and took it right back up. Here, this was broader, and this would be a good time to exit the trade right at this point. Now, in addition to that, let me share with you some profile insights that make this even a more compelling exit for the trade. My next 240-minute period has formed. Okay, right here we see it. And now I have a value area high for it. I've closed above the value area high, and I'm still in the trade. I continue to move higher, but then now notice what is happening. I am coming back to the value area low, and this time I have a negative close when I hit my value area high. That is an indication that the market has weakened, and we are probably going to continue to move lower. Now, we could in fact move lower to come back for a retest of this volume point of control, and if that fails, we will move even lower back to here. In any event, it is a strong enough indication using my volume parameters, using my profile and value area parameters, that I should be exiting this trade. I made it above the value area high. Now remember, if in fact I was coming into the market at this point, this is an opportunity. I am outside of value for this 240-minute period. But if you're outside of value and this is what your next 30-minute candle looks like, are you inclined to think that we're going to go higher and take this further up? The answer should be no. because in fact it has closed lower. It has a strong wick at the top, and I would anticipate that we are going to continue to move lower, which in fact we did. We never really experienced a breakout up here on the upside, even in the following session. So instead, what did we end up getting? We ended up getting a breakdown. Notice also here, there are no spoons. There's no spoon to be found anywhere here at the street. Unlike this beautiful trade here, where we could see the spooning effect, there was nothing going on there. So this humble trade, 240-minute trade, would have yielded 50 pips. 50 pips at 100,000 lot, that's around $500. And the duration of this trade would have been about 240 minutes. 240 minutes is about 4 hours. So that's a 4-hour intraday trade in the Forex market. All right, ready for another trade? Let's take a look at another trade. Now, what is the outcome of the cluster of this 240 period? We just did look at it, and you did see the outcome, but I want to show you how you can really predict the outcome given the knowledge that you have now. So first and foremost, let's identify the value area high from the preceding session, and let's take a look at the value area high of this actual session, which is the next 240, and here is my value area low for that same session. So what is happening here? Well, we found resistance here. We come back to it, and every time we hit it, it brings us back down to the value area low. Then finally, we end up closing right here, and we're right on the value area high. So we're not above value technically, but maybe there's a possibility we may continue higher. But look at what happens. The next 30-minute period, I end up getting a double top at the top, and the next 30-minute period closes below the value area high. My level of confidence begins to decrease. Now, the following 30-minute period takes me lower yet. Then we come back for a test of the value area low, and it brings us back up to the value area high. Notice the different rotations. But then the following candle takes me back down to where I was. Here is the beginning of my potential breakdown. Notice, first of all, I have what is known as a bear sandwich. And a bear sandwich is simply two negative candles with one positive candle in between, and you can see it there, and that's a very negative pattern. In addition to that, my simple 5 is now pointing lower and looks like it's even crossing the 8 to the downside. So if anything, I should be developing a very strong bias to the downside. And what I would be looking for is when in fact am I going to see prices drop and take out the low of this prior candle. And if we take a look at how things develop, we will find that the resistance at the value area high at the top has held. We will find again that we also have a very strong bearish candlestick pattern. And we have a close below. The close now is below the prior value area high. Actually, a close here below, see this value area high of the prior period? We closed below it. So now we are not able to hold the high of the prior period. We're not able to hold the high of this period. Two highs that we can't hold. And we are waiting for the time when, this time, instead of prices trading above the value area, when will prices begin trading below the value area for this 240-minute period? Sure enough, the opportunity comes. Prices begin trading below it right here. We take out the low of this last candle. This would be a very good point for the entry to enter at this point. If you wanted to really wait until you take out the low of this candle, That is also another reasonable entry. That you could do that. It is more cautious, but it is a viable option. And now take a look at what begins to happen when we enter here. And remember how I described the moves for you in the Forex market. They tend to be fairly quick and fairly rapid. Look at the extent of the drop within this 30-minute period. The problem, if you didn't have the profile, by the time you realize that you are in a downtrend, it's a little too late. It's very difficult to capture the moves. The beauty of the profile and the value area and price moving away from value on the Forex, once you see that, is you are really able to get into these moves when they start, when they begin, and capture the full move. Take a look at the beautiful move down with the two moving averages, the simple 5 and the 8, and we have an entry short at 1.3554. And we take this down all the way during this 240-minute period. And during this 240-minute period, when would we decide to exit? We have two nice moving averages that continue to move lower. And notice we have every 30-minute candle closing below the simple 5. This is the first time I've had a bullish candle close green, but it's still closing below the simple 5. I would exit the minute the first candle closes green above the simple 5. It could be that we will continue lower, but this would be a very good point for me to exit. I can always go back into the market. And if in fact I had captured this move, another move that took about 240 minutes in the market, a 4-hour move, it was a 154 pip move at 100,000 lot. That's a little bit over $1,500. The 240 profile on the euro US dollar is just remarkable. And when you add these two moving averages to it, it just really helps to see these opportunities as they occur. All right, now to recap our lesson, a few key points I want to emphasize. The purpose of this lesson was really to demonstrate how powerful the profile tool is in its most basic form. The strategies that we've used are all very simple, and they're simple because of the power of the profile. Now, what really helped us was being able to select the right time frames and the right profile settings. So keep in mind that that is a very critical part of your strategy. And most important of all, I want you to realize that the profile will give you an edge in trading, and we've only just begun. The profile and its concepts are remarkable, and once you begin to employ and apply them into in the market correctly, you will be amazed at the results they will produce. With that, I am going to conclude our lesson for today, and as usual, I like to reserve the full lesson time for going over the content and the material we will discuss. And I'd be happy to entertain your questions via email, so don't hesitate. Send them out, and I've been trying to answer all of them as quickly as I can. With that, I will wish you the best of luck with your trading, and till our next lesson.